Hey there and welcome. Ever wonder how big companies keep track of literally thousands of transactions every single day without everything just falling apart? Well, today we're pulling back the curtain on one of the foundational secrets to clean, organized accounting: subsidiary books. It's a great question, right? At first glance, it seems like a ton of extra work. Why would you want a whole bunch of different books when theoretically you could just cram everything into one single journal? Well, as we're about to find out, what works in theory doesn't always survive in the real world. I mean, just picture it: a super busy company. Every sale, every purchase, every single return, all getting shoved into one giant book. It's what you'd call a bookkeeping bottleneck. It's incredibly slow, it's a nightmare to check for mistakes, and forget about trying to have more than one person work on it at a time. It's a system that's just begging for trouble. Let's use an analogy to make this super clear. Think about your kitchen. What if you had one massive everything drawer? Forks, knives, spatulas, pots, pans, all tossed in together. You'd spend half your time just looking for a spoon. It's just chaos. And that's exactly what a single journal feels like for any business that's starting to grow. And this is where subsidiary books come in to save the day. They are just like those specialized organizers in your kitchen. Instead of one messy everything drawer, you have a dedicated spot for sales, another one for purchases, a spot for returns. You get the idea. Each book has one and only one job to do. It brings instant order to the financial chaos. Now, the really key thing to remember here is that subsidiary books are where transactions get recorded for the very first time. That's why they've got this other name, books of original entry. Think of them as the front door, the first stop for all those common, repetitive transactions before they go anywhere else. And the benefits of this system? Oh, they are huge. You can split up the work, so multiple people can be recording things at the same time. People get really good and fast at their one specific book. And because everything's so neatly sorted, finding a piece of info or, tracking down a pesky error becomes so much easier. It's all about being smart and efficient. So we get the why, but what exactly are these different books? Let's meet the main players in this system. For the most part, the names tell you exactly what they do, right? You've got a book for purchases, one for sales, one for returns, and so on. But that last one, the journal proper, that one's interesting. You can think of it as the catch-all. It's for any transaction that's kind of unique and doesn't fit into any of the other specialized books. Now, to keep this whole thing from turning back into a mess, each book has super strict rules about what can and can't go inside. You can't just put things wherever you want. So to really understand how this works, let's use the purchases book as our main example. Okay, this rule is absolutely crucial. The purchases book is only for two things. One, it has to be a credit purchase, and two, it has to be for the goods the business actually sells. So, if a stationery shop buys pencils on credit to put on its shelves, boom, it goes in this book. But what if they pay cash for those pencils? Nope, that goes in the cash book. And what if they buy a new office computer on credit? Well, a computer is an asset, not something they resell, so that goes somewhere else entirely, into the journal proper. See how specific it is? All right, so the rules make sense, but what does making an entry actually look like? How do we get from a piece of paper, an invoice, to a nice, clean record in the book? The process is really simple and always the same. Let's just walk through a quick example. First, you list out the items and what they cost to get your total. Let's say it's 3,380 rupees. Then, step 2, you subtract any trade discount. If it's 10%, that's 338 rupees. And that's it. The final number, 3,042 rupees, is what gets recorded in the book. Clean, simple, and standardized every time. So we've got all these individual books, full of neatly organized transactions. But what's the end game here? How does all this detailed work connect back to the company's main financial records? This, my friends, is where the real magic happens. For this part, let's switch over and look at a sales book. This one is for a company called M/Kishore & Sons. You can see it lists all the sales they made on credit for a certain period, to different customers on different dates. And at the very end of that period, the entire book gets totaled up. And for this period, that grand total is 1,921,100 rupees. Now think about this. This one number might represent dozens, maybe even hundreds of individual sales. Instead of posting every single one of those sales into the main accounting records, we're just going to use this one clean summary figure. And that leads us to the final and most important step in this whole process. Where does this one powerful consolidated number actually end up? That total, that 192,100 rupees, is posted as a single line item to the credit side of the main sales account in the ledger. And that's the payoff. All the messy details stay in the subsidiary book, while the main ledger just gets a clean, simple summary. This saves a massive amount of time and prevents the most important books from getting cluttered. And really, that's the entire system in a nutshell. You have the specialized subsidiary books to handle the day-to-day details as efficiently as possible, and then you have the main ledger, which stays clean and gives you that big picture overview. It's a really smart solution for managing tons of information without losing your mind. So now you get it. You understand the power of this system. But we're all human, right? Mistakes happen. Someone might accidentally put an asset purchase in the purchases book. What happens then? How do you fix that kind of mistake without making an even bigger mess? Well, that's a great question for another time.